Certainly. Here is a detailed summary of The Little Book of Common Sense Investing. The Only Way to Guarantee Your Fair Share of Stock Market Returns, by Jack Bogle. Introduction. The Idea of Indexing. Jack Bogle's The Little Book of Common Sense Investing is a fundamental guide for individual investors looking to maximize their stock market returns through the practice of index investing. Bogle, the founder of the Vanguard Group, emphasizes the simplicity and effectiveness of owning a diversified portfolio of stocks that mirrors the performance of a broader market index, such as the S&P 500. This approach, according to Bogle, provides the best chance for investors to capture their fair share of market returns over the long term. Chapter 1. A Parable, The Gotrocks Family. Bogle introduces the concept of index investing through the story of the Gotrocks family, who own all the companies in America and thus earn all the profits of these companies. Over time, various helpers, investment advisors, managers, etc. promise to help the Gotrocks earn more, but instead, they end up taking a share of the profits for themselves, reducing the family's overall wealth. The parable illustrates how costs and fees eat into investment returns, and how a simple, cost-effective strategy of holding the market can outperform more active approaches. Chapter 2. Rational Exuberance, The Relentless Rules of Humble Arithmetic. Bogle explains the irrelentless rules of humble arithmetic, emphasizing that while stock market returns can be high, the returns earned by investors are lower after accounting for fees, expenses, and taxes. He advocates for the use of low-cost index funds to minimize these deductions, allowing investors to keep a greater portion of their returns. Chapter 3. Cast Your Lot with Business. Investing in stocks is fundamentally about owning a share in real businesses. Bogle stresses the importance of long-term investing in a diversified portfolio of stocks, which historically have provided substantial returns. He warns against the allure of market timing and stock picking, which often result in lower returns due to the unpredictability of market movements and the costs involved. Chapter 4. How Most Investors Turn a Winner's Game into a Loser's Game. Despite the strong historical performance of the stock market, many investors achieve subpar returns due to high costs, frequent trading, and poor timing. Bogle presents data showing that actively managed funds, on average, underperform the market after fees. He argues that by simply buying and holding a low-cost index fund, investors can avoid these pitfalls. Chapter 5. The Grand Illusion. This chapter delves into the illusions and myths of active management. Bogle debunks the notion that professional fund managers consistently outperform the market. He presents evidence that the majority of actively managed funds fail to beat their benchmark indices, especially after accounting for costs. He attributes this underperformance to the zero-sum nature of the market, where one investor's gain is another's loss, and the additional burden of management fees and expenses. Chapter 6. Taxes are Costs, 2. Bogle highlights the impact of taxes on investment returns, noting that active trading often leads to higher tax liabilities. Index funds, with their low turnover rates, are more tax-efficient, allowing investors to keep more of their returns. He advises investors to consider tax implications when choosing their investment strategies and to prefer tax-efficient investment vehicles like index funds. Chapter 7. When the Good Times No Longer Roll. Bogle cautions investors against extrapolating recent high returns into the future. He discusses the cyclical nature of the stock market and the inevitability of lower returns following periods of exceptional performance. He urges investors to maintain realistic expectations and to focus on long-term, rather than short-term, results. Chapter 8. Selecting Long-Term Winners. Bogle examines the difficulty of identifying future outperforming funds. He points out that past performance is not a reliable predictor of future success, and that most funds that perform well over one period often fail to maintain their performance. He argues that low-cost index funds, which do not rely on market predictions or manager skill, provide a more reliable path to long-term success. Chapter 9. Yesterday's Winners, Tomorrow's Losers. Continuing from the previous chapter, Bogle discusses the phenomenon of reversion to the mean, where periods of above-average performance are often followed by below-average performance. He emphasizes the importance of consistency and long-term perspective, advocating for index funds as the best means to achieve stable, reliable returns over time. Chapter 10. Seeking advice to select funds? Don't count on it. Bogle is critical of the financial advice industry, noting that many advisors and brokers have conflicts of interest that can lead them to recommend high-cost, actively managed funds. He advises investors to be wary of such recommendations and to focus on low-cost, no-load index funds as the most effective investment strategy. Chapter 11. Focus on the lowest cost funds. Cost is a critical factor in investment success. Bogle presents compelling evidence that low-cost funds consistently outperform high-cost funds over the long term. He explains that even small differences in expense ratios can have a significant impact on an investor's final returns due to the compounding effect of costs over time. Chapter 12. Profit from the majesty of simplicity and parsimony. Bogle advocates for a simple, straightforward approach to investing. He argues that complexity and frequent trading add unnecessary costs and risks. By focusing on a diversified portfolio of low-cost index funds and maintaining a long-term perspective, investors can achieve superior results with less effort and stress. Chapter 13. Bond funds and money market funds. While the primary focus of the book is on equity index funds, Bogle also discusses the role of bond funds and money market funds in a diversified portfolio. He emphasizes the importance of low costs in fixed income investing as well and recommends bond index funds for their simplicity and efficiency. Chapter 14. The Exchange Traded Fund, ETF. Bogle offers a critical view of ETFs, noting that while they can be low cost and efficient, their liquidity and ease of trading can tempt investors to trade too frequently, undermining their long-term returns. He advises investors to use ETFs cautiously and to focus on holding them for the long term, just as they would with traditional index funds. Chapter 15. Index funds that promise to beat the market. Some index funds and ETFs aim to outperform the market by tracking specialized or enhanced indices. Bogle warns that these funds often carry higher costs and additional risks, and that their performance may not justify the added expenses. He recommends sticking to broad market index funds for the best balance of cost, risk, and return. Chapter 16. What would Benjamin Graham have thought about indexing? Bogle reflects on the teachings of Benjamin Graham, the father of value investing, and suggests that Graham would likely appreciate the principles of index investing. He notes that indexing aligns with Graham's emphasis on long-term perspective, minimizing costs, and avoiding speculative behavior. Chapter 17. The Relentless Rules of Humble Arithmetic. Reiterating the core message of the book, Bogle emphasizes the importance of the relentless rules of humble arithmetic, the basic mathematical principles that demonstrate why low-cost index investing is the most effective strategy for individual investors. By focusing on minimizing costs and maintaining a long-term perspective, investors can maximize their share of market returns. Chapter 18. The Case for Indexing in a Nutshell. In the concluding chapter, Bogle summarizes the key arguments in favor of index investing: lower costs, broad diversification, tax efficiency, and consistent long-term performance. He urges investors to adopt this simple, common-sense approach to investing, which offers the best chance of achieving financial security and success. Conclusion: common sense for a lifetime. Bogle concludes with a call to action for investors to embrace the principles of common sense investing. He stresses that while the financial industry often promotes complexity and active management, the most effective strategy for most investors is simple, low cost, and patient. By following the advice in this book, investors can improve their chances of achieving their financial goals and securing their fair share of market returns. Bogle's The Little Book of Common Sense Investing is a testament to the power of simplicity, cost efficiency, and long-term thinking in achieving investment success. By advocating for index funds, Bogle provides a clear and actionable path for individual investors to navigate the complexities of the financial markets and build lasting wealth.